Welcome to the Deep Dive. Today, we're tackling a really interesting one, a company that's seen massive shifts, lots of debate. Alibaba Group Holding Limited, ticker BAA.
That's right. And we're digging into this investment memo. It's dated June 14th, 2025. It really tries to get to grips with whether Alibaba is, a wonderful company you can hold for the long term.
Yeah, and our goal here really is to pull out the core insights from this analysis. It's dense, right? Alibaba is huge, complex. We want to help you understand what actually matters here.
Exactly. Cut through the noise. Because let's face it, there's been a lot of noise around Alibaba.
For sure. Regulation, intense competition, big strategy changes. It feels like it's constantly under the microscope.
Yeah.
So is the question still about its fundamental quality, or has it fundamentally changed?
That's really the heart of it. Is it adapting, or is it, maybe a value trap? And to understand that, the memo stresses you can't just think online store.
Right. It's a much bigger.
It's a whole digital ecosystem. Think of two main pillars holding it up: e-commerce, the core, and cloud computing.
Okay, so how does this sprawling thing actually bring in revenue? It's different from Amazon's model, mostly, right? They don't own the goods.
Exactly. Mostly, they're the intermediary. They build the digital roads, the marketplaces, connecting millions of merchants with hundreds of millions of consumers in China and beyond. They run the platform.
Gotcha. So looking at the numbers in the memo, this is for fiscal 2023. What are the biggest chunks?
Well, the main profit engine, historically anyway, is the Taobao and Tmall group, TTG. That's like 43% to 46% of revenue. That's the big China e-commerce piece.
And Taobao and Tmall are slightly different.
Yeah. Taobao is more C2C, consumer to consumer. Think individuals, small businesses, kind of like eBay back in the day. Tmall is B2C, business to consumer. That's what bigger brands, the official stores, set up shop. It feels more curated.
And the money comes from?
Primarily services to those merchants, charging them for marketing, for ads to get noticed, commissions when they make a sale, other value-added services, high margin stuff.
Okay, so that's the famous asset-light model. They're not generally buying and holding piles of inventory.
Precisely. And that was key to their initial growth. It let them scale incredibly fast without needing billions for warehouses and stock like Amazon's first-party business. Higher margins, less capital needed up front.
But you hear that maybe that model had downsides too, made them vulnerable somehow.
It did. Because they didn't own the whole chain, the inventory, the logistics for every single transaction, it created openings. Competitors could focus on specific niches.
Like who?
Like Pinduoduo, PDD, who just went all in on low prices and group buying, or JD.com, who built this massive, reliable logistics network, promising speed and authenticity, owning the inventory. They could attack areas where Alibaba maybe wasn't as strong.
Okay, so beyond that core China e-commerce, what else is significant in the revenue mix?
You've got Alibaba International Digital Commerce, that's AliExpress, Lazada, their overseas platforms, roughly 10% of revenue. Then Cloud Intelligence Group, Douyin, also about 10%. That's their cloud computing arm. And increasingly, everyone sees that as the key future growth driver.
Okay, cloud's important.
Caneo, their logistics network. Another 10% or so. It's the essential plumbing for everything, really. And then the rest is a mix of other things, local services like food delivery, digital media.
And the memo suggests those other bits weren't always pulling their weight.
Yeah, the analysis uses the term strategic drag. Some of these, like digital media, apparently struggled for profitability. They soaked up capital, management focus, but didn't really deliver strong returns.
Which explains the big restructuring, the 1 + 6 + n thing.
Exactly. Management basically said, okay, we got too complex, too spread out. So they broke the company into these separate units, started selling off non-core assets like the in-time department stores. It's all about focus. Getting back to basics.
Makes sense. But fundamentally, the core idea, making it easy to buy and sell stuff online, that feels pretty timeless, right?
But their mission,
make it easy to do business anywhere, aiming for 102 years. That sounds solid.
The underlying need is timeless, definitely. And the internet's not going away. The question the memo grapples with is whether Alibaba's specific platforms can maintain their dominance against really tough, well-funded competitors.
Which brings us neatly to the moat, their competitive advantage. What's the main defense identified?
It's the classic powerful network effect, especially on Taobao and Tmall. It's simple. More buyers attract more sellers because there's a huge audience. More sellers mean more product choice, which attracts more buyers. It's a virtuous cycle.
A flywheel.
Exactly. With, over 800 million active users in China, it creates this massive gravity. It's just really hard and expensive for a new player to replicate that kind of scale quickly.
So if you're a new brand, you almost have to be on Tmall.
That's the example the memo uses. Imagine a new international cosmetics brand entering China. Launching on Tmall gives them instant access to that huge user base, plus integrated payment with Alipay, integrated logistics via Cainiao. It's the most efficient path.
Building that yourself would take years and cost a fortune.
Right, so brands feel they can't afford not to be there. That's the moat in action. There are secondary moats too, like cost advantages from their scale in tech and data, and intangible assets like the brand recognition of Taobao and Tmall.
And this seems like a big but, in the analysis, while the moat is there, its edges are being attacked. Its dominance isn't what it was.
This is really crucial. The core network effect is still strong, but its effective dominance has narrowed. The numbers are stark. Look at Table 1, and the memo estimates show their China e-commerce market share falling from over 60% in 2020 down to maybe 41% by 2024.
Wow, that's a huge drop in just a few years. Who's picking up that share?
Primarily PDD, Pinduoduo, with its aggressive pricing, and JD.com leveraging its logistics and reputation for authentic goods. And then you have Douyin, TikTok's sibling in China, which has really effectively blended video content with shopping.
So different models appealing to different consumer behaviors are finding success.
Exactly. And the regulatory crackdown definitely played a role.
Yeah. The big fine in 2021.
Right, specifically taunting that choose one of two policy, where they pressured merchants to be exclusive to Alibaba platforms. Getting rid of that leveled the playing field significantly. Brands could suddenly list everywhere without fear, which directly helped competitors gain traction.
So the moat isn't destroyed.
No, not at all. They're still massive, still very profitable, huge user base, incredible scale, but it's not the only game in town anymore.
Less of a monopoly toll bridge, more like one major highway among several competing ones.
That's a good way to think about it. JD, PDD, Douyin, they're all major highways now, too. Alibaba has to fight harder for traffic. Which is why you see this new management focus on user first. It's an admission that users and merchants do have viable choices now. The moat shifted from near monopoly to a strong advantage in a very competitive oligopoly.
Okay, let's shift perspective. What's the view from inside Alibaba? How do customers and employees see it, according to the source?
It's really interesting, quite a split view, especially for customers, depending on which platform we're talking about.
Okay.
So for Alibaba.com, the B2B wholesale site connecting international buyers with Chinese suppliers, the vibe seems to be tolerated, not loved.
Tolerated because it's necessary. Cheap sourcing.
Yeah, it offers access to a massive range of suppliers, often at very low prices. But the memo points out it's often a buyer beware situation. Common complaints are things like unreliable suppliers, product quality not matching descriptions, disputes being hard to resolve fairly. Buyers feel the trade assurance system can sometimes lean towards protecting the seller. So you use it because you have to, but you need to be really careful.
That sounds very different from their consumer platforms in China.
Night and day, almost.
Yeah.
For Taobao and Tmall, the sentiment described as much more positive, liked to loved.
Really? Why the difference?
Tmall is seen as the premium spot, trustworthy, where you find official brand stores. People compare it more to Amazon's marketplace, better authenticity, better service generally.
And Taobao, the C2C one.
Even there, the system seems to work better for building trust. The memo highlights the detailed seller ratings, the hearts, diamonds, crowns. That system apparently helps buyers identify reliable individual sellers, and many users have strong loyalty to specific Taobao shops they trust.
So it sounds like a deliberate strategy. Maximize supplier quantity on the B2B side, but curate and build trust mechanisms much more heavily on the consumer-facing sites.
Seems that way. Now, for employees.
How's morale? Is it a good place to work?
Again, a bit mixed, but largely positive, according to the reviews cited, on Comparably. Overall favorability is reportedly high, 91%. People rate compensation well, respect the CEO, their teams.
So it's pretty standard for a big tech firm. Pride in working there.
Yeah, pride in being a tech leader, working with smart people. The company values, like customer first, are mentioned positively.
Okay, but what's the catch? there's usually a catch.
The big one is the culture. The infamous 996 work schedule, 9 a.m. to 9 p.m., 6 days a week. That comes up a lot. Intense pressure, high risk of burnout.
Right, that's legendary. Anything else?
There are also mentions of big company disease. This apparently came from a departing senior employee. Things like strategic goals sometimes being unclear, more bureaucracy creeping in, decisions feeling opaque, the challenges of managing massive scale.
That sounds like a real internal battle, trying to stay agile and fight competitors while dealing with that kind of internal friction.
It's a definite tension. You have this fast-paced, demanding culture, maybe partly because of the bureaucracy trying to force output. And it makes executing that big strategic pivot we talked about, the focus on core, the AI push even harder. The restructuring, that 1 + 6 + N, is probably also an attempt to fight that internal complexity, make units smaller and more nimble.
Okay, let's talk leadership and financials. New CEO recently, right?
Yes, Eddie Wu, he's actually one of the co-founders, known as a real tech guy, took over as group CEO in September 2023. And significantly, he also took the CEO job directly for the two businesses he sees as absolutely core: TTG, e-commerce, and cloud.
Sending a signal about priorities. What's his game plan based on that shareholder letter the memo mentions?
The analysis boils it down to three main things. First, strategic clarity. Basically, stop chasing everything. Focus intensely on e-commerce and cloud. Any other ventures have to clearly support those two. It's a break from the diversification of the past.
Okay, focus.
Second, user first. This sounds obvious, but it's framed as a renewed, pragmatic push to really improve the experience on their platforms to keep users coming back, especially now they have choices.
A response to the competition.
Definitely. And third, AI-driven. This is the big bet. Going all in on AI, using their own model, Quinn, they see AI not just as a tool for efficiency, but as something that will transform the entire business. Wu apparently expressed real urgency, like, if we don't lead on AI, we'll be toast.
Focus, users, AI.
Got it.
How is the money following that strategy, the capital allocation?
This is where the memo shows a really dramatic shift, looking at Table 2 data covering fiscal 23 to 25. It's moved towards much more disciplined, shareholder-friendly deployment.
How so?
While R&D spending is still strong, as you'd expect, but the huge change is in Capex capital expenditures. It nearly tripled in fiscal 2025.
Whoa, where's all that money going?
Explicitly targeted at AI and cloud infrastructure, directly funding that AI-driven pillar, building out the data centers, the computing power they need. And at the same time, the era of big, splashy acquisitions seems over. They've actually become net sellers of assets, like spinning off the in-time department stores, focusing the portfolio.
And what about shareholders?
That's become a primary focus now, returning capital. The numbers are huge. $16.5 billion returned in fiscal 2025 alone through buybacks and dividends.
$16.5 billion, that's serious.
It is. The buybacks cut the share count by over 5% in just 1 year, and they've upped the authorization for more buybacks, another $25 billion available. It signals a real commitment to returning cash to owners.
So the spending pattern really matches the strategy. Invest heavily in the future core, AI, cloud. Divest the distractions and give cash back to shareholders.
What about the overall financial health? Is it still that earnings machine? It was an incredible earnings machine. The analysis confirms it was consistently profitable for ages. But yeah, recent years have seen more pressure, more volatility. GAAP earnings can jump around a lot because of things like the value changes in their investment portfolio, which isn't really about core operations.
Right, non-cash stuff, so non-GAAP is a better guide.
Generally, yeah, for the underlying operational trend. And the memo notes non-GAAP net income was basically flat in fiscal 2025 compared to the year before, even though revenue grew modestly, around 6%.
Flat earnings on growing revenue means margins are getting squeezed.
Exactly. That's the cost of fighting harder against competitors and making those huge AI investments while revenue growth isn't exploding like it used to. The 30-40% growth days are gone.
What about key quality metrics? Like return on invested capital, FCF conversion, balance sheet.
Okay, so ROIC, which tells you how well they use their capital to make profits, has definitely come down. Table 3 in the memo shows it's been around 9-10% recently. Historically, it was way higher, like high teens or even 20s.
So still decent, but not spectacular like before.
Right. It reflects that moat pressure we talked about. They need to invest more capital now, the IC part, for returns that aren't growing as fast. But free cash flow conversion, how much profit turns into actual cash, that's still really strong. The core commerce business just generates tons of cash. That recent dip below 100% conversion, the memo attributes that directly to the big surge in Capex for AI, not weak operations. It's an investment showing up in the cash flow calculation.
And the balance sheet. Still strong.
Oh, yeah. The analysis calls it a fortress. They've usually had a huge net cash pile, over $50 billion in late 2024. Very little debt relative to earnings. Net debt EBITDA around 1.4x.
And why is that so important now?
It's critical. It gives them breathing room, flexibility. They can afford the massive AI spending. They can weather competitive storms, navigate regulatory uncertainty, and keep returning cash to shareholders, all without putting the company's survival at risk. It's a huge strategic asset.
Okay, let's bring it all together. Looking ahead. Where's the growth supposed to come from? What are the biggest things that could go wrong? So what's the final take on valuation?
The analysis is pretty clear. The number one growth engine is meant to be that AI-driven transformation, with Alibaba Cloud at the center. That's the new strategic core.
And how does AI drive growth, practically speaking? Two ways.
Yeah, two main channels. First, embedding AI, their Quen model, into the existing e-commerce platforms, using it to make search better, recommendations smarter, ads more effective for merchants, just making the whole thing run more efficiently.
Okay. Enhance the core.
Second is growing the cloud business itself, capturing the huge demand for computing power that's expected as AI takes off across China. The memo mentions the recent deal with Apple, where Alibaba Cloud will provide infrastructure for Apple's AI features in China as an early sign of that potential.
Sounds promising, but the risks? The analysis highlights some serious ones that could cause permanent damage.
Absolutely. Real long-term risks. The biggest, and maybe hardest to quantify, is the unpredictable regulatory environment in China. The government can and has reshaped entire industries. Future antitrust actions, new data rules, anything could happen that permanently hurts the business model or valuation. It's a constant uncertainty.
A major shadow hanging over it. What else?
The risk that the competition just keeps getting tougher permanently, that the era of easy dominance is truly over, and they face a future of relentless market share battles and margin pressure from PDD, JD, Douyin, and others. If that happens, it could be that classic value trap scenario,
where the stock looks cheap but just keeps getting cheaper because the business is fundamentally eroding.
Precisely. Then there's the risk that the big AI bet fails. They're spending billions on this. What if their tech isn't good enough? What if they can't commercialize it effectively? What if someone else out-innovates them? All that investment could end up destroying value, leaving them with no clear path for future growth.
High stakes.
Very high. And finally, that internal risk we touched on. Big company disease. Can this huge, complex organization actually move fast enough, execute well enough to win in this rapidly changing landscape? Or will bureaucracy and internal friction cause a slow, steady decline?
Those are definitely significant risks. So how does the analysis weigh all this against the stock price? The valuation piece sounds key.
It really is. The analysis points out the stark disconnect between Alibaba's current valuation and its own history. We're talking low to mid-teens price-to-earnings ratio, maybe 12x to 17x price-to-free cash flow, although that FCF multiple is a bit skewed low by the current high Capex.
Which is way, way lower than it used to trade, right? It used to be 25x, 35x PE.
Easily. A massive discount. And the core judgment in this memo is that despite all the risks, the current price makes it an attractive entry point for a long-term investor.
Attractive, even with regulation, competition, execution risk. Yeah.
The argument comes down to margin of safety. The analysis suggests the market is pricing Alibaba as if it's already broken, like it's low quality, super high risk, with zero growth prospects. It seems overly focused on the challenges, maybe ignoring the enduring strengths.
Strengths like?
Like its continued market leadership in a huge market, its massive scale, that fortress balance sheet, the fact it still gushes cash flow, and that it has a credible turnaround plan focused on AI and cloud. The current valuation seems to bake in perpetual decline, which feels inconsistent with reality. You're not paying for blue skies at this price. You're getting a big buffer for things going wrong.
So the low price reflects fear more than fundamentals.
That's a big part of the argument. The memo talks about a sentiment multiple, dragging it down the China discount, fears about regulation, the VIE structure complexity, geopolitics. An investment now is partly a bet that this extreme negative sentiment will eventually ease up, even if just partially.
Just briefly, VIE structure.
Ah, right. The variable interest entity. It's basically a legal workaround Chinese companies like Alibaba use to list on overseas exchanges like the NYSE. Because China restricts direct foreign ownership in key sectors like tech, VIEs use contracts to give foreign shareholders economic exposure to the company's profits without actual direct ownership. It works, but it adds a layer of legal and regulatory uncertainty because its standing could, in theory, be challenged by Beijing. It contributes to that China discount.
Got it. Okay, so there's the market consensus view and then this maybe more contrarian view from the analysis. What's the general take on the street?
The consensus described is basically, yeah, it's cheap, but it's cheap for a reason. It's a value trap. People acknowledge the low valuation, but think it's justified because the risks, regulation, competition, geopolitics are just too big. The common view is that Alibaba is kind of stuck, maybe managing a slow decline.
Okay, that's the consensus trap argument. What's the counter argument? What does the memo suggest the market might be missing or underappreciating?
It highlights a few key things. First, the durability of that core e-commerce moat. The market might be pricing it for death, but the network effect is sticky. The memo suggests the business is stabilizing, it's still the biggest player, and there are even some early signs like accelerating growth in what merchants pay for ads that suggest pricing power isn't totally gone. The moat is pressured, yes, but maybe not broken.
So underestimating the core's resilience. What else?
Second, potentially missing the huge asymmetric upside from AI and cloud. The market mostly sees that massive AI spending as defensive, risky, maybe wasteful. This analysis frames it differently as a massive, undervalued call option on China's whole digital future. If cloud really takes off, or if AI transforms the core business, the upside could be enormous, and the current price assigns very little value to that possibility. Cloud alone could be worth a big chunk of the current market cap if valued separately.
Interesting. So hidden optionality. Anything else?
The third point is the market perhaps hasn't fully grasped the financial implications of the new aggressive capital return policy. That shift to prioritizing buybacks and dividends, generating potentially close to a 7% cash return yield annually at the current price, around 5% buyback, 1.7% dividend, fundamentally changes the equation.
How so?
It directly combats the value trap narrative. You're not just sitting there hoping for a turnaround. You're getting paid a significant cash return while you wait. It provides a kind of valuation support or floor, and it aligns management's actions much more closely with shareholder interests.
Right. That brings us towards the end of this deep dive into the analysis of Alibaba. We've gone from the complex business model through the challenged moat, inside the company's culture and customer views, looked at the new leadership, the financials, the AI pivot,
and weighed those significant risks against a valuation that's, frankly, historically low. The core tension running through this memo is really clear. Is Alibaba, a former giant, successfully adapting to a much tougher world, finding new growth in AI and cloud? Or is it destined for slow decline, making the current stock price a mirage?
Yeah, the analysis presents compelling points on both sides. So the final thought for you, the listener. Given that deeply discounted price, the clear strategic shift towards AI, and the huge amount of cash being returned to shareholders, is the market right to price in decline? Or is this a rare chance to buy a durable, albeit challenged business at a price that dramatically undervalues its long-term potential? What really stands out to you after hearing this?